You have spent the better part of a decade aggressively saving, tracking every penny and fueling your dreams with the promise of the 4% rule. You were told that if you reach that magic number, that specific multiple of your expenses, the math would take care of you. You would be free. You would be done. But it is 2026. The world you prepared for no longer exists. That 4% rule wasn't built for a reality defined by AI-driven market volatility, skyrocketing medical inflation that swallows savings whole, and a global economy that moves faster than your portfolio can react. If you are still relying on a strategy designed in 1994 to navigate the turbulence of this decade, you aren't just stagnant, you are vulnerable. Right now, there are retirees sitting on what they thought was a perfect portfolio, watching in quiet terror as their purchasing power evaporates. They did everything right according to the old playbook, and yet the ground is shifting beneath their feet. The cold, hard truth is this: that rule is no longer a life raft. It has become a trap. If you don't change your framework, the market will eventually reclaim what you worked so hard to build. Today, we are going to tear down the outdated pillars of FIRE and reconstruct a strategy that actually works in 2026. This isn't about saving more, it's about surviving the shift. Let's get into it. To understand why your retirement plan might be failing right now, we have to pull back the curtain on the gold standard of personal finance, the 4% rule. Born in the mid-90s, this rule suggested that if you withdrew 4% of your portfolio in your first year of retirement and adjusted that amount annually for inflation, your money would, in theory, last for 30 years. It was simple, it was elegant, and for a long time, it served as the bedrock of the FIRE movement. It gave millions of people a clear, quantifiable target to hit. But let's be brutally honest, that rule was a product of a world that no longer exists. That script for financial independence was written during an era of relative stability, low interest rates, and predictable market growth. Today, we are living in a fundamentally different landscape. The economic climate of 2026 is defined by structural shifts that the original 4% rule simply never accounted for. We are looking at a perfect storm of radical technological disruption and a complete recalibration of how wealth is valued. Let's talk about the math of 2026. If your portfolio is designed based on the assumption of normal inflation, it is currently being gutted by the silent inflation of healthcare. We aren't talking about the typical rise in the cost of groceries or consumer goods. We are talking about long-term care and private medical expenses that are rising at a pace far outstripping the standard consumer price index. If you are retiring today, you aren't just fighting the cost of living, you are fighting a healthcare bill that could realistically double or triple over the next 2 decades. When you factor that in, that 4% withdrawal rate doesn't just look aggressive, it looks reckless. This rule was once the scripture of the FIRE movement. It was the bedrock of stability. But that was when the world was predictable. Now, we're living in an era of constant high-frequency disruption. Think about the labor market. We are seeing artificial intelligence displace traditional roles at an unprecedented scale, which is fundamentally altering how companies grow, how they generate profits, and consequently, how your assets are valued. The predictability of market returns that the 4% rule relied on is effectively gone. It's been replaced by a level of volatility that makes a fixed withdrawal rate mathematically dangerous. When your expenses are rising exponentially due to the structural shifts in the economy, but your portfolio is anchored to a static, dated percentage, you are essentially watching your financial future evaporate in real time. You have to realize that clinging to a strategy from 1994 to navigate the markets of 2026 is an exercise in futility. You are operating in a dream world where the underlying assumptions have already been discarded by history. The numbers have changed, the risks have mutated into something far more complex than a simple spreadsheet can capture. And if you don't adjust your withdrawal logic to account for this new reality, you are essentially gambling with your survival. Many people feel a strange sense of comfort in these old rules because they provide the illusion of a finished puzzle. They want to believe that if they just follow the steps, they will be safe forever. But this comfort is a trap. The 4% rule wasn't designed for a world where AI-led transformation forces the entire market to reprice itself every few months. It wasn't designed for a world where sovereign debt pressures and geopolitical fragmentation create ripples that hit your savings account before the news even reports them. We need to move past the fixed rate mindset, but before we can build a better, more resilient system, we have to fully recognize why the old one is breaking. It isn't just market noise, it's a structural failure of an outdated model. By acknowledging that this standard is no longer the safety net it was promised to be, you open the door to a more sophisticated, more honest way of managing your wealth. And once you accept that the rules of the game have shifted, you can stop playing by the old ones and start positioning yourself for the realities of the next decade. We need to transition from set it and forget it to a model that is capable of absorbing the shocks that are clearly on the horizon. If the fixed rate model is broken, what replaces it? This is where we need a fundamental shift in perspective.
Most people treat financial independence as a static finish line, a number on a spreadsheet that once hit grants them a lifetime of freedom. They view it as a destination. You work, you save, you hit the number, and then you cross the threshold into a life of permanent leisure. But in the current economic landscape, that is a dangerous fantasy. It assumes the world will hold still while you enjoy your retirement. Instead of viewing FIRE as an end state, you must start viewing it as a dynamic system. This brings us to the core shift, moving from the rigid 4% rule to dynamic withdrawal. In a volatile market, a fixed percentage withdrawal isn't a strategy, it's a high-stakes gamble. Think about the math. If the market takes a 20% hit in the very year you retire, a sequence of returns risk that has destroyed many retirees, and you stubbornly continue to pull your fixed 4%, you are essentially cannibalizing your own principal. You are selling assets at their lowest possible valuation. You are locking in losses that your portfolio may never recover from. Once that spiral starts, it is nearly impossible to stop. The dynamic withdrawal method changes the logic entirely. It is about building in guardrails. In years where the market is thriving and your portfolio is reaching new heights, you might pull a bit more to enjoy the fruits of your labor. You allow yourself to participate in the upside. But in years where the market is struggling, you throttle back. You tighten your belt, reduce your spending, and let your portfolio recover. You let your cash flow breathe in rhythm with your portfolio's actual performance rather than forcing it to march to an arbitrary beat. But here's the deeper twist, the one that truly separates the 5% from the rest. Most people fixate on the wrong question. They walk into financial advisor offices or sit at their computers, stressed and exhausted, asking, "How much money do I need to stop working?" It's a question born of fear. It forces you into a state of panic, compelling you to hoard every single cent because you are terrified of the day the paycheck stops. It turns your life into a race to accumulate a mountain of gold large enough to survive until your last breath. The question you should be asking instead is, how do I build financial latency? Financial latency is the buffer zone. It's the ability to pause, to pivot, and to wait out market cycles without being forced to sell at the wrong time. It is the tactical advantage of not being desperate. When you have latency, a market correction isn't a catastrophe, it's just a season. You have the flexibility to adjust your lifestyle, to draw from other reserves, or to let your assets sit and compound while the market finds its footing again. It turns your portfolio from a ticking clock into a flexible engine. When you stop chasing a magic number and start building a system that can absorb shocks, you aren't just retiring, you're insulating yourself against the unpredictability of the 2026 economy. You are no longer a victim of the daily fluctuations. You are the architect of your own stability. This shift isn't about being smart enough to predict whether the market will go up, down, or sideways tomorrow. Nobody can do that. Not the hedge fund managers, not the algorithms, and certainly not the experts on cable news. This is about being disciplined enough to build a system that doesn't care what the market does. It is about removing the human ego from the equation and replacing it with mathematical resilience. Once you see the world this way, the anxiety begins to dissipate. You realize you don't need to be a Wall Street genius to achieve true freedom. You just need to be a better architect of your own survival. You move from a passive observer of your bank account to an active manager of a system designed to endure. And this leads us to the most critical part of the process, the actual playbook for building that system. Because knowing the theory is one thing, but knowing how to execute it in an age of AI, market volatility, and rising costs is where the real work begins. We aren't just talking about abstract concepts anymore. We're talking about the specific, concrete moves that allow you to step out of the 95% and into the security of the 5%. But before you get into the exact mechanics of your new defensive posture, you need to understand why your brain has been fighting you every step of the way. You have been playing a game with outdated tools, and now it's time to upgrade your arsenal for the years ahead. So how do you actually execute this? If the old playbook is obsolete, what does the FIRE 2026 manual actually look like? It comes down to 3 non-negotiable pillars: defensive asset allocation, diversified income streams, and the surgical application of AI. First, let's talk about your portfolio's architecture. For years, the FIRE community leaned heavily into pure equity index funds. That worked when interest rates were near zero and the tech sector was in a perpetual, uninterrupted bull run. But today, that level of concentration is a liability. You need to transition into a hybrid model. You must bridge the gap between high-growth assets, like the AI and infrastructure sectors that are driving modern economic efficiency, and hard, defensive assets that protect you when the world feels unstable.
We're talking about gold, commodities, and real assets that have historically acted as a hedge against fiat currency debasement. This isn't about market timing. It's about balancing your exposure so that when the market fluctuates, you aren't forced to hit the panic button. You aren't just betting on the future, you are ensuring your present. Second, consider your income structure. If you are still relying 100% on a fluctuating stock portfolio to fund your daily retirement expenses, you are living on the edge. In 2026, diversified income is not an option, it is a structural necessity. You need at least 2 distinct streams of cash flow that are completely detached from the daily volatility of the stock market. Whether it's physical real estate, royalties, or a side business that operates independently of your investment portfolio, these streams act as your buffer zone. When the market enters a downturn, these flows are what allow you to leave your investments alone. They are what allow you to wait out the storm rather than being forced to sell into a crash. This is the difference between a retirement that survives a bear market and one that collapses under the first sign of pressure. Third, you have to leverage AI. We aren't just talking about using chatbots for casual research. We are talking about using AI to optimize your personal financial efficiency. In 2026, there are tools that can analyze your spending patterns, automate tax loss harvesting, and rebalance your portfolios with a precision that would have taken a human advisor days to calculate. Use this to your advantage. Don't waste your cognitive energy on mundane tracking tasks. Automate the management of your wealth so you can focus your time on the high-level strategy. AI is the tool that gives you the oversight of an institutional investor right from your home office. Now, I know what you're thinking as you hear this. This sounds fundamentally different from what I've been doing for the last decade, and that is exactly why you need to hear it. Many of you are currently suffering from what psychologists call the sunk cost fallacy. You have spent so long following the old, rigid rules that you feel a sense of loyalty to them even as you watch them fail you in real time. You have invested your time, your identity, and your hard-earned savings into the 4% rule lifestyle, and letting it go feels like admitting defeat. You feel that if you change your strategy, you are somehow invalidating the work you did to get here. But let me be clear, this is not defeat, it is evolution. You aren't losing your past progress, you are protecting your future. The market does not care how long you have been using a specific strategy. It does not care about your emotional attachment to a formula from 1994. The market only cares if your current strategy can withstand the realities of 2026. If you are clinging to a dying methodology just because you've used it for a long time, you are risking the very freedom you worked to achieve. You need to detach your identity from the strategy. The strategy is just a tool, and like any tool, it must be upgraded when the environment changes. We are living in a period of unprecedented geoeconomic fragmentation and technological disruption. If your financial system is static, you are essentially trying to navigate a hurricane with a map from a different century. This isn't about being more productive in your saving habits. It is about being more intelligent in how you structure your resilience. And once you begin to view your finances as a system that requires constant maintenance and adaptation, you start to see the path toward a type of security that the rest of the world is too fearful to build. But before we wrap this up, we need to address the most critical takeaway, the one thing that will determine whether you drift in this economy or whether you actually come out on top. Ultimately, you have to realize that true financial freedom is not found in a specific balance on your bank statement. That number is just a snapshot in time. Real freedom? It lies in the resilience of your system. It is the ability of your financial architecture to adapt, bend, and evolve before the pressures of the macroeconomy can break it. We are moving into a world where the old, rigid formulas are no longer enough to protect your lifestyle. You cannot control inflation. You cannot control market cycles. You cannot control the technological disruptions that will redefine entire industries over the next few years. But you can control how your capital responds to those forces. You can shift from a passive, fixed-rate mindset to an active, dynamic system that isn't just surviving, but thriving amidst the chaos. The 4% rule belongs to a different era. It is a relic of the past. The future belongs to those who build flexible, multi-layered systems that can weather any storm. You have the tools, you have the strategy, and you have the clarity to move away from the herd. The question is no longer whether you can do it. The question is whether you are willing to make the shift. If you are ready to stop relying on outdated math and start building a portfolio that actually respects the realities of 2026, then take the first step today. Let me know where you stand. Drop a comment below with the word flexible. If I see enough of you are ready, I will put together a deep dive breakdown on how to restructure your defensive asset allocation to handle what's coming next. The market doesn't wait for anyone, and neither should you. It's time to move. Thanks for watching.